of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher, the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months, between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
In today's episode, momentum analyst Micheal Oliver delivers a stark warning that could shake every investor to their core. The financial system is about to experience its most catastrophic failure in modern history. While most Americans remain glued to their portfolio apps watching green numbers climb higher, Oliver's technical analysis reveals we're living through the final moments of the greatest monetary illusion ever created, where decade-long zero interest rates and money printing on an unprecedented scale have inflated asset prices to impossible levels that defy all economic reality. Moreover, Oliver warns that Bitcoin could trigger the crash as a psychological and financial ambush to stock markets. His momentum analysis shows Bitcoin displaying the exact same crash pattern as the 1987 S&P 500 collapse, with critical support levels at $101,000 that won't hold if tested. Since corporations are now heavily embedded in crypto, unlike previous cycles, a Bitcoin crash would create devastating ripple effects throughout traditional markets. The analyst predicts silver will explode to 60 to 70 by year-end as it catches up to gold's massive gains, while commodities led by crude oil prepare for their own explosive breakout above 68 per barrel. Oliver emphasizes that when this 52-card pickup scenario unfolds, the pain will be so severe that major institutions like the Federal Reserve could be abolished within a year or two as public doubt destroys confidence in the current monetary system. Now we'll show you more clips of the latest interview, but first smash the subscribe button and turn on notifications so you do not miss out on our daily recaps.
Right.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay. Still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals. First off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? Do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table. Okay. That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point. Fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows it has been. In fact, the U.S. has had silver as official money too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's no longer 20 cents, okay? Anyway, there's a point at which the pain gets so bad that it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now, pending.
The recent surge in silver prices, which briefly touched a decade high, aligns with trends observed in other precious metals like gold. The U.S. Federal Reserve's interest rate cut cycle has established a pattern for silver's fluctuations in the second half of 2025. The market in September was significantly influenced by the Fed chairman's dovish remarks at the global central bankers' annual meeting and the release of U.S. July PCE data, which aligned with expectations and further bolstered monetary easing. According to the CME FedWatch tool, market expectations for a Federal Reserve rate cut increased substantially, influencing gold prices to approach previous highs and silver prices to surpass prior peaks, reaching levels not seen in nearly 14 years. Also, the potential erosion of the Fed's independence could be one of the major factors significantly impacting the U.S. dollar's credibility. Markets are concerned that U.S. monetary policy may become politicized, potentially leading to simultaneous declines in stocks, bonds, and currency values. This situation has increased the demand for safe haven assets such as gold and silver, providing liquidity support in the short term. On August 25, the U.S. Geological Survey released a draft update to the critical minerals list, proposing to classify 6 minerals: copper, potash, lead, rhenium, silicon, and silver as critical. While this event hasn't immediately affected short-term silver prices, concerns persist that the U.S. may invoke Section 232 of the 1962 Trade Expansion Act to impose hefty tariffs on imported silver ingots and powder. CD notes the U.S. relies on imports for 64% of its silver supply, with current COMEX futures premiums underestimating tariff risks. The U.S. relies heavily on imports for its silver supply, and current COMEX futures premiums might be underestimating the risks associated with such tariffs. The expectations for U.S. Fed interest rate cuts, combined with existing geopolitical risks, are the primary drivers behind the recent price increases. The dynamics of supply and demand fundamentals support a bullish trend for silver prices, influenced by steady domestic industrial consumption and potential short-term supply disruptions. Let's show you the remaining clips of the interview.
We use the Bloomberg Commodity Index, which is a fairly well-balanced index. It's not too heavily on energy like some of them are. Okay. It made a high in 2008 and again in 2011, coincident with gold back in 2011. And back then, those highs were 230 something on the Bloomberg and 170 something. Right now, Bloomberg, first off, after that, in 2020, after gold had already doubled, Bloomberg kept going down. So it wasn't in sync with gold. Gold doubled between 2015 and 20. Bloomberg continued down until 2020 and got into the 50s. Something was in the 200s, got into the 50s. So you call it cheap. That's a category that got cheap. And I'm talking, it was pretty representative. Crude oil drop, grains, etc. Since then, it rebounded in October 2020. We called a bull move up. It went to 140. Still cheap, but it doubled. Okay. It's since pulled back 2023, 2024, and now to 100. And it's been dead asleep sideways for 2.5 years on the price chart. You look at it and say, gosh, nothing's going on here. It's not going down. It's not going up. When we go inside the Bloomberg and look at the key components like the grains or crude oil, for example, and do a momentum study of Bloomberg Commodity Index plus the component sectors in the commodity category, we see pending upside breakout levels that look dynamic, meaning that as gold has been going up, commodities have not, they look like they're ready to join gold this time, which is exactly what happened in the late 1970s. Late in the gold bull trend, they suddenly said, we're here too. And they went up explosively while the stock market was going down, by the way. They look primed for that. Crude oil right now is trading a 61 to 65 zone for the last couple of weeks. WTI crude futures. Next quarter, I'll give you a number. It doesn't show up on a price chart as being terrifically important at all. $68 monthly close during next quarter. And I'm going to break out over a quarterly momentum trend structure that if you saw the momentum chart, which doesn't look like the price chart, you'd say, oh boy, I got to be long that beast if it breaks out. The commodity complex looks primed to turn up. It may wait a bit because quite often it's money flow issues. It's not just the specific fundamentals of corn or oil. For example, if the equity structure starts to break, money goes somewhere. If they perceive that commodity stocks and commodities are dirt cheap and not risky, because they're not going down, they've been living for 2.5 years sideways, money could flow into that category. And suddenly you could take oil up and not even need an excuse. It's just that it's too cheap, too long. I think that's about to happen. It hasn't happened yet, so don't jump the gun. But when we cross our various numbers, we're going to raise the flag and say, that's it, commodities are now joining in. Now that will create further upset to the average guy because he was promised that oil was going to stay down and that gasoline in the pump was going to stay low. Well, you take crude oil up to 68 next quarter and close a month there, it ain't going to stay low. You're going to get a sudden upsurge in gasoline prices. And that's going to upset, again, a notion of stability that isn't a stable situation. And that upsets people because, hey, if there's nothing true, then everything's up in the air. And what does that create? Panic, uncertainty, and sharp market movements. Mm-hmm. The dollar index, which is what most people look at, is 70% comprised of euro and yen. So what you're doing is you're looking at the euro and yen upside down, basically. Also the British pound, Canadian dollar, Australian dollar, etc. But the primary weight is the euro and the yen in that order. Okay. The dollar index right now is trading at 97.5 as we speak. Okay. You go back 10 years to December of 2015, when gold made its low at $1,050, the Bloomberg Commodity Index is where it is right now, 10 years ago. You could draw lines sideways. Yeah, it's been above it and below it, but it's net for 10 years sideways, and yet gold is tripled in half. So if you're in gold, don't pay too much attention to what the dollar's doing day to day, week to week, or even month to month. But when it becomes a destabilizing factor, and for example, the dollar index in 2023 and 2024 was dead sideways between 100 on the dollar index and about 107, 108. Got up to 110 briefly, but it was in a narrow 7% range for over 2 years. totally dull, a non-factor in global money movement in terms of causing impact. In March of this year, it dropped back down to 104.21 after being up to 110, a fake breakout. It down to 104.21, has since dropped to 97 recent lows. We got bearish at 104.21 on a long-term basis. We argued that the dollar is now entering a major bear trend, dollar index, relative to these other pieces of paper, and is likely to go back down, even challenge its all-time low down in the 70s. Major move, in other words. So suddenly Forex, major Forex, which has not been an active mover for a couple of years, 23, 24, no movement, is suddenly now a player. Okay, so if you're a foreign investor and you invest in U.S. bonds, or you invest money in the U.S. stock market, as a lot of them have over recent years, if you get kicked by the dollar, S&P goes sideways, but you lose 7% in the dollar, you've lost that money because you have to convert it back to euros to enjoy it, So it can impact other markets. And it's not really gotten it speedy yet, but I think it's going to get speedy soon, meaning the downside become more noticeable. But we're major bearish on it, and I think it'll become a player again in world market movement.
What do you think of today's episode? Do you agree with Micheal Oliver that this stock bubble will collapse and the Fed can't save it this time? Will Bitcoin crash trigger the broader market meltdown? Is silver about to explode past $60 as Oliver predicts? Post in the comment section down below your honest opinion, share this video with someone who needs this market crash warning, and check our other videos. Thank you.